Okay, money. What is money? Let's just glance through this because you kind of got the idea from the video. What is it all about? The big picture. Why do we need money in the system? You know, if we didn't have the money, it would be very hard to exchange goods against goods. Very hard to find. Let's say you have a pair of shoes and you want to just buy some milk, and you go to the farmers. Farmers have milks, but it doesn't need your shoes. You know, then maybe someone else has shoes, but it doesn't need uh, uh, milk. You know, it's going to be very hard, right, and time consuming. That's what we created money. All right. What do we mean by barter? Exchanging one good or services against another one. And this required double coincidence of ones, which is hard to do. Okay. If I need a gallon of milk, but I have a zucchini, pound of zucchini, uh, I got to find somebody has the gallon of the milk and at the same time wants my zucchini. Okay, that's going to be double coincidence of ones. And that's kind of very hard to accomplish. Unlikely occurrence that two people each have the goods and services that the other one wants. Okay, that's what we created money. We made it money. Okay, it makes the trade easier. Then, what do we mean by money? Okay, is a set of assets in the economy that people regularly use to buy goods, services from each other. Okay, pretty simple question. You know, common sense here. Now we call it money is more liquid asset in your portfolio, which means everything that you have. Let's say you got one car, you got one house, you got furniture, a bunch of books, and tools and all that is all belong to you. And among those, you got maybe say $2,000 cash too. Among all those assets that you have, that money we call is most liquid asset. Liquid, just like water, is easy to move, right? Which means if you want to buy something, then you got that money, you can go buy it. Otherwise, if there is no cash in your portfolio, you want to buy something, you have car, you got houses, you got a lot of assets, you got a lot of money, right? I mean, a lot of wealth, a lot of stuff that worth something. But to get that item that you want to buy with cars is hard to do. Again, go back to barter. The guy might not want a car. Then you got to sell your car, it takes a while, cash it, and then to go buy the other one. That's what we call money is the most liquid asset among your portfolio. Okay, ease with which an asset can be converted into economy's medium of exchange. Again, I don't expect you to memorize all this definition and all that, but just once you understand it, you get the idea. Okay, money has three functions. Okay, functions of money. Right? Medium of exchange. Okay, item that buyer give to the sellers when they want to purchase goods and services. Okay, is a medium of exchange. Is a unit of account. Okay, unit of account. Let's say yardstick uses to post prices and record debts. Okay, well, unit of account. Let's say uh, we want to measure the height, the length of something. Okay, what do we use? We use uh, a stick, right? If it's in um, uh, meter or foot or inches and so on, then you use that stick. You say, okay, each one of them is a 1 meter or 3 feet. Then the height of this boy is, let's say, 1 yardstick. okay, 3 feet, okay, or 3 feet and 5 inches. Okay, that's the unit of account for measuring the height. But for economy, we use money as a unit of account. Okay, we're not saying, let's say we want to see how much Bill Gates, Microsoft CEO and founder, worth. Okay, well, to add up all his belongings, that let's say he has a mansion, he has 5 cars, he has a few houses, you have books, he has clothes, it's going to be a book to write down. And that's all his belongings, that's all his wealth, right? Then we use this unit of account. It says, okay, Bill Gates worth uh, $50 billion. Okay, that's the unit of account. Okay, yardstick people use to post prices and record debts or their wealth. A store of value. Okay, what do we mean by that? Money, you can store value in the money. Okay, let's say you have a gallon of the milk, a few gallon of the milks, uh, and they have value, right? They have use value. It's a milk, it's good, right? But you can't keep it forever, right? It goes bad in a few weeks and all that, right? Well, you can sell it and hold that value in the money that you receive. Okay, keep the value. People can use to transfer purchasing power from present to future. That milk has a value now, but it cannot be transferred to future because the milk go bad. You can go sell it and transfer it, the value of that milk, to the future. Okay, just make a note of these 3 functions of the money. Okay, now what kind of money we have, right? Well, we've got commodity money, okay, and what do we mean by commodity? Commodity money, money that has value besides being money. Okay, let's say you have a gold coin. It used to be silver, gold as a means of transaction in societies, right? Then, besides being gold, besides being money, it was gold. It has a value, which is it has an intrinsic value. Um, Value, that item has the value even if they're not money. Okay, that's commodity money, which has intrinsic value. Item would have value even if it's not money. Okay, like gold standard. Gold was money. Okay, used for transaction, but at the same time, gold has a value. People use it as jewelry or in manufacturing and things like that, besides being money. Okay, or we have gold standard. Even we have paper money, as you see on that video. It was backed up by gold. Okay, let's say a dollar or silver. A dollar at the bottom of it. If you have those old dollar bill, early 20th century, it's still backed up by gold. You could take it to the bank and say, okay, here it says this paper money here, it worth 1/16 ounce of silver. I want my silver. Okay, that's how it was. Now, then we change it. Okay, then we got commodity money versus fiat money. Fiat money is the money that does not have intrinsic value. That's the money that we have these days. Okay, without the intrinsic value, which means if it's not money, if not backed up by government, if people don't accept it, it's a piece of paper. Okay, it's worthless. Okay, if you see dollar bill and $100 bill, it both paper, some inks, some picture on them. It doesn't have no intrinsic value. It's just a piece of paper. It has value because the government decree, government order, government back it up. Okay. Fiat money, money without intrinsic value that mostly used these days, used as money because of the government decree. As you see in any bills that you have access to, you got a bunch of writings in there, right? One of them says this note. which means this money, this paper, is legal tender for all debts, public and private. That's it. Okay, is ordered by the government, but collective uh, order of society to accept it among each other. Okay, using it for all kind of transaction, private or public. Okay, is by order. Okay, or decree. That's the fiat money. Then we got two kind of money: fiat money and commodity money. Right? Commodity has intrinsic value, even if it's not money, it has a value, like gold, silver, and all those stuff that that video talked about. Different societies, different part of history, they use different commodity as money, right? Gold standard, this was very popular, right? And we just dismantled it a few decades ago. Uh, Everybody accepted gold as a means of transaction, as money. We call that gold standard. Even if it was paper money, but it was backed up by amount of gold. Okay? But nowadays we just use fiat money. Okay, fiat money. How do we create fiat money and how it goes and all that through the transaction, through the societies? Well, we're going to talk about it in Federal Reserve Bank and government and all that, right? Money is stock, okay, is money in the circulation, okay, money in circulation. Well, we've got different type of money we're going to talk about, okay. Money is stock. Well, let's say we take a snapshot right now. Just stop the time and go dig through everybody's pocket, wallet, banks, vault, corporation. See how much money each one has right now if you stop the time. Okay, add them all up, put them in the pile, and count it and see how much it is. Yes. Okay. Then the currency, we're talking about paper money and coin. Okay, paper money and coin. That's you all used to. Okay, but there are different kinds of money we're talking about. Currency, which is paper money and coin, we count it all out. We come up maybe $1.434 trillion. Okay. Everybody's money, pile up together. I might have $2. Somebody else might have $100. Banks might have $1 million sitting there in their vault, and government might have $3 billion. And add them all up. That's called the stock of money. Okay, quantity of money is circulating in the economy. Take a snapshot of it, how much it is. Then we call that money stock. Okay. Later we're going to talk about supply of money and demand for money. And we're going to deal with this definition. Quantity of money, circulating in the economy. Now, we're going to divide it in different branches. Currency, okay, as I said, is a paper money and coin in the hands of people. Now, what is demand deposits? Okay, what is demand deposits? Okay, demand deposits are balances in the bank account. Depositor can access on demand by writing a check, or simply demand deposit or checks. Okay, well, if you have checking account, some of you might, and what do? You carry a little book in your pocket. You have the name of the bank, your name on it, and blank, pay to, and so on, right? Those are also money too. That's kind of new phenomenon. Okay, it didn't exist, centuries and centuries ago. It's a new phenomenon. You open up the bank, the people can deposit their money, a bank can lend the money out. At the same time, we created this checking deposit, this demand deposit. Then is the money, right? If you go to the mall, you don't have no currency, but you have your checkbook with you, right? And you buy a pair of shoes. It says how much? It says $100. Then you tear up one page and you write $100 to Foot Lockers or whoever, you sign it, your bank address is there, the guy take it, and that's money. That's money. Okay? That's the demand deposit. Now, we call these two together M1. Okay, currency and demand deposit, we call them M1. Demand deposit, traveler checks, other checkable deposit, and currency. Or say currency plus checking account. Okay, for checking account, we call it M1. Okay. Now, M2 is M1 plus all other stuff. Okay. Then M1 is the whole money. Okay. In the system. M1 is the belly of it. Okay. Is M1. It's kind of weird, you know, but the whole thing is M2. Okay. It's not M1 and M2. Okay. The whole thing is M2, which has M1 plus the other stuff. Okay. Let's see. Look at it here. This is M1, currency and checking deposit. Well, we add, you know, traveler checks and other checkable deposit also. Okay. Or simply say checking account and checks and currency. Now, M2 is M1, right, plus saving deposit, a small time deposit, money market mutual funds, and a few minor categories. Again, I don't expect you to memorize all this, but you know, just look at it. I mean, for your quizzes, I usually don't give you a test that based on, you know, memorizing word to words. You have to analyze. Then here, let's see. Guess what? Here, this is actually amount of money in our economy back in January 2016. Okay, when we took a snapshot, count everybody's money in the system in January 2016, how much did we come up with? $12 trillion. Okay, $12 trillion. Okay. This is in billion. This is in billion, and we come up $12.5 trillion money circulating in U.S. economy. Okay. Now, among that, 3.2 trillion is currency and checking deposit. Okay, and the currency alone probably is 1.5 or 1.6 or 1.4, I would say, trillion, and the rest of them is checking deposit. Then you see, currency is not that big amount of the money in the circulation. Really, it's the smallest part of our money supply, which is M2. Okay, that's a lot of money in the circulation, right? Okay, just make sure you get the whole idea, the big picture of the economy with this much money circulating around, right? And how much have influence in changes of the economics forces, you know, purchasing power of the people, or lending ability of the banking system, or firms and government can borrow and lend, you know, this amount of money in the circulation. We kind of break it down more to see how it functions, how it works. Okay. All right. It just give you this few slide here talking about 1.4 trillion was currency among that 12.5 trillion, right? 12.5 trillion almost in money, total money, M2. Okay. 1 point was just currency. Okay. Now, if you divide this by our population, It means average adult holds about $5,500 in their pocket, either checking or currency. Oh, well, I mean, just currency. Just currency. Okay? I don't know. Did we have one? Well, that's 2016. 2020 probably was even more. 7,000, 8,000 on average. Cash, carry cash. I don't have that. None of you do have that. But where is that cash carries with who? By who, right? Much of them held abroad. Okay, a lot of foreign governments, like China, got a lot of cash, $1 billion US dollar cash sitting in their vault. They own it, they have it. Or other countries that deal with, import export, right? Or we have some of the, euro, Japanese money in here too. And also, a lot of them held by drug dealers, tax evaders, and other criminals. Okay, you see all those old movies, Hollywood movies, these gangsters, they're dealing drugs and all that. The guy delivering the drug, he says, "Where's my money?" He says, "Okay." He opened up the trunk of the car. He got 4 or 5 suitcases out there, or sometimes one. He opened it up, a stack of $100 out there, right? And he says, "Yeah, here is $2 million in this briefcase here." Okay, then exchange it, right? Because they don't want to be traced. They can't write a check, okay? They can't write a check to the guy because they trace it out, right? That's what they use it most, okay? Or some people do transaction. They want a cash transaction to avoid tax, okay? That's another reason. That much cash in hands of people, right? Some countries, they're trying to dismantle the big bills. I remember we just started a few years back printing $500 bill. I'm sure you all haven't seen that bill, $500 bill. Now the biggest one, we got $100. That's it, right? We took it out. We took the $500 bill out of circulation. We might took the $100 bill out of circulation too. Indians doing it too. Why? They try to make it harder on criminals. Right? Imagine drug dealers want to sell, $1 million worth of drug, and the highest bill is going to be $5 or $10. Instead of 2 suitcases, you got to have 20 suitcases to do the transaction, right? You got to carry a big car or a truck load of money to do exchange. That's why they're trying to get the big bills out of the circulation, make it harder on those tax evaders and other criminals. Okay, currency, not a good way to hold wealth. It's not good if you have currency, you have $1 million asset in your portfolio. Why you want to keep that much cash in your portfolio? Because it could be stolen. Also, it could be losing its value because of inflation that we already established, right? Or you don't gain interest. You can buy security from the government, bonds, or you can put in a saving account and gain interest from it. It's not a good way to hold your wealth in currency. Now we're going to talk about who is in charge of money. Okay. Our system called the Federal Reserve System. Federal Reserve Bank is a bank, okay, in charge of our money. Which is a central bank. Every country has a central bank. Okay. It's an institution designed to oversee the banking system and regulate the quantity of money in the economy. Each country call it differently. We call ours the central bank, which is Bank of Banks, Federal Reserve Bank. Japan, they call it Bank of Japan, or England call it, Central Bank of England. Or anybody name it differently. Ours is called Federal Reserve Bank, and Fed for short. Okay, is the Central Bank of the United States. We created, these are kind of new phenomena. We created early 20th century after a series bank failure in 1907, and the reason for it was to ensure a health of nation's banking system. Okay? Before then, everybody has some money, they could open up a bank. Okay, like J.P. Morgan banks, Chase Bank. You see all these names, right? You got about 6,000-7,000 commercial banks scattered all over the United States. You see it all over, right? Like gas station. Then who are they? Okay. Well, it's just the business people. They open a bank, have a little money in there on their own, and they said, okay, we want to put money with us. We give you a little interest rate, right? As you saw on that tape. Then it's safe, and we are big, we have name, we are popular, like Mr. Morgan, J.P. Morgan, or Mr. Chase back there a century ago, and people knew them. They said, yeah, we might as well put our money in there instead of putting under the mattress or under the pillow. It might be stolen, and all that is safe. Okay? And he says, yeah, whenever you want to come get it, we give it to you. And they go turn around and advertise and say, who want to borrow money? We have money sitting there. But actually, it's not their money, right? It's other people's money. But they notice that there was a certain amount of those money is there. Seldom. Everybody rush to the bank and they want to get their money out at the same time. Okay? They always maybe have 60% of those money sitting there. And they said, well, okay, we might as well lend this money to people who want to borrow and charge them interest, and we keep the difference. Okay, that's why this bank got rich and rich. And these are the same bank that started J.P. Morgan, okay, Chase Bank. These are initially started creating this business, right? And what happened in 2000, World War I, around early 19th century, a lot of these banks has a lot of money of the people in there, and they just closed and shut down, got the money and run away. Okay, or through a lot of banks robberies, the gangsters run to the bank and stole the money. And those are people's money. And you go get the money from the bank is, I'm sorry, somebody just came and stole your money, and it happened. It happened a lot. Then society think, well, we've got to have something to monitor these banks, okay, secure it. And then we created Federal Reserve Bank, which monitor these commercial banks, okay? One of the things they do is insure depositors' money. If the bank goes under, they run away, or people run to the bank, get our money out, and they don't have it there, the government can guarantee those. Tell the depositors that you're insured, you're okay. If the bank fails, we rescue you. Okay? That's what we created central bank to monitor all the banking in the system. Okay? We're going to see how it works. Okay. Our Federal Reserve Bank, well, this is just the organization here. They have a board of governors. They have 7 members in there, and they serve 14-year term. And if one of them expires, whoever is the president, they can appointed one. We just recently Jeremy Powell appointed by President Trump, and before that Janet Yellen, before that and Bernanke and all that. Okay, these are appointed by president. Okay, and they have one chairman, which is right now is Jerome Powell. Okay, before that was Janet Yellen. This book is kind of 2 years ago, 4 years ago, and it directs the Fed staff, presides over board meetings, testify regularly about Fed policy in front of the Congress, and appointed for 4 years by the president. The chairman was, okay, all those 7 members. Okay. Then Federal Reserve Bank is in Washington, D.C., and also have 12 other ones in major cities. There's one of them in Dallas, one in Philadelphia, one in Denver, one in San Francisco. There are 12 of them. They're scattered around, and each one of them monitor the commercial banks in that region. Okay, to monitor those banks to see if they're okay. They don't lend out all the money. Okay, call it a fractional reserve, or do they have enough money in case if people run in there and get that money out? They monitor those things, right? Then the Fed job is regulate banks and ensure the health of banking system. Regional Federal Reserve Bank, remember, it was 12 of them, monitors each bank financial condition, facilitates bank transactions, okay, facilitate that, clearing checks. There's so many checks is written every day, which is about over almost around $3 trillion worth of, or $2.5 trillion worth of money circulated by checks. And also the Fed acts as banks of bank. Okay? Bank, Chase Bank, Bank of America, you can go open up an account as an individual. Get a checking account if you want to write a check and so on. But you can't go open an account on Federal Reserve Bank. Okay? This is the bank that belongs to the banks. Banks have an account in their bank. It's just like Bank of Banks. And also, it is the lender of the last resort. Okay, the lender of the last resort. Let's say Chase Bank. Okay, let's say this is a Chase Bank. Okay, and Mr. Chase Bank, you got a lot of money in there, right? You got maybe $10 billion. Okay, 10 billion. People's deposited it. Okay, people that have money, they all deposited it, and they go lend it out. Okay, people put their money in here, and people come get this money. Okay, these are borrower. Okay, these are borrower, and these are lenders. Okay, okay. These guys make interest, even 5%. Okay, even 5%, and charge these guys 10% on average. They do some of them 20%, some of them 5%, some of them 6%. It just depends. Let's say on average, right? Then he keeps 5%. That's how banks make money, right? Let's say as of this 10 billion, okay, 8 billion is lent out. Okay, and you got 2 billion left. Okay. Let's say these people here run to the bank and they want to get their money out, maybe $8 billion. Bank doesn't have $8 billion. They got $2 billion. then what they're going to do? They used to shut down and they get this 2 billion and run away. Okay? And they say, sorry, we don't have money. Your money is handed us here. If you want it, you have to wait. Or sometimes these people borrow money, they just refuse to pay back. They go bankrupt. Then what's going to happen, right? Then that's why we have Federal Reserve Bank. It's bank of the bank. Now, this bank, if it's in trouble, these people come and get $8 billion from them. What is it going to do? It's coming to Federal Reserve Bank. It said, I'm in trouble. I'm $6 billion because this, guy, billionaire, didn't want to get all his money out, but money is not here. Okay, now this Fed is the lender of the last resort. He's going to give him the money. Okay, he's going to go. He says, okay, I give you $6 billion, then you'll be okay. You pay me back as these people pay you back. Okay, that's how the system works. We used to didn't have that one, the central bank. Now we created that, the central bank, ours called Federal Reserve Bank, to secure the solvency of the commercial banks. Okay, to secure it. Okay, make him functional. Now, how do they do that? Where they get that $6 billion? Okay, where they get that $6 billion? Okay, that's what we're coming to call it fractional reserve ratio. Okay. All right, let's go back to fractional. You should put fractional reserve ratio here. Okay. We go to fractional reserve ratio. The Fed says, okay, Chase Bank, you have, remember, $10 billion from depositors. Okay. You can't just lend all of them out. You can't lend 10 billion out. Okay. You gotta keep fraction of it with me. Okay. Let's say 10%. You got to keep 10% with me, which is $1 billion. If all the banks do that, Federal Reserve Bank is going to have a lot of money sitting on it. Not all the banks, they're going to go bankrupt at the same time, right? 1, 2, sometimes they do. Then he has enough money to rescue 1 or 2. Okay, that's called fractional reserve bank. Banks hold only a fraction of deposit as a reserve. As a reserve, okay? Maybe if 10%, then he has to hold 10% of them as a reserve. That's why Federal Reserve Bank monitor these guys, okay, to see if they have 1 billion. Then reserve ratio is fraction of deposit that banks hold as a reserve. And reserve requirement means minimum amount of reserve that banks must hold set by the Fed. Now let's go back to where we were. That was 20. We were on 14, right? Okay. The Fed is the lender of the last resort. Now, okay, the Fed job is control the money supply, quantity money available in the economy. And how do they do that? By monetary policy, by buying or selling government bond in federal open market, okay, and by FOMC. What does FOMC stand for? Federal Open Market Committee. Who are these people and how they change the money supply in the economy? Now, this is kind of monetary policy, how government can manipulate the economy If in recession, how can use monetary policy to boost it up? Or we are in inflation, economy running too hot, how can we use monetary policy to slow it down? Okay, one of the tools is the Federal Open Market Operation, okay, done with FOMC, or Federal Open Market Committee. It can affect money supply, okay, through monetary policy. Okay, it can affect quantity of money available in the economy and setting of the money supply. Okay, let's see how. FOMC, that committee, has 12 members. 7 members of the board of the governors. Remember, we had 7 board of governors in Federal Reserve, and they pick another 5 from those 12 regional banks. They just randomly pick 5 of them. Okay, and they make 12 of them, and they meet every 6 weeks in DC to discuss the condition of the economy, and they consider changes in monetary policy. It's a big deal. Okay, it's a very important function of our economic system done by this committee here. If they decide to go buy or sell government bond, okay, remember we already talked, the bond is a piece of paper. It has principal on it, maybe 1 million. It has interest on it, maybe 5%, and you have date of maturity. Okay, government sold this to borrow money, okay, and to do other stuff, right? The banks or publics, corporation, they hold this money. Those people have money, they go buy these bonds. Okay. Now, if the government go buy back these bonds, okay, that's what they do. They purchase or sell of this bond. If they buy it back, what happened to the money supply? Okay. They say banks own some of these here. Okay. Or Microsoft owns some of these. Corporation owns some of these. Or individual owns some of these. The government come and give him a good price. He said, hey, the principal is in 1 million, mature in 5 years. I buy it now from you. I give you 1 million now, okay, and give me this back. And when that happened, what happened to the money supply and circulation? It goes up. It goes up. Then, to increase money supply, Fed goes buy these bonds. Okay. To decrease money supply, sometimes we want to just kind of slow down the economy. It's running too hot. We go sell these bonds. Okay, get the money out of it. Okay, just remember this slide here. Let's just glance through here a little bit more. We know the money is currency and demand deposit. That's the M1, right? And let's just disregard the other part of the M2. Let's just work on M1. We know what the behaviors of the banks are, right? Get the money from depositors and lend it out to the borrowers, right? But it can influence the quantity of the deposit in the economy and the money supply. Banks can do that, right, by raising and lowering interest rate, okay? Or government can control that by setting off the reserves, by setting off the reserve. Remember the fractional reserve ratio? Let's say, I don't know if you all or not, but let me just glance through kind of basic accounting here. Let's say this is a bank. Any businesses, they have accounting, we call it T. You see, this is kind of like T, okay? and to post the transactions. Okay, let's say this is an accounting T transaction for First National Bank. Somebody come deposit $100. Okay, how do we show it? We say, okay, it's got to be balanced always. We say bank's asset went up $100, call it reserves or cash, same thing. Somebody came, put $100 to this bank. This bank now, it got $100, right? Now, on the right side, we say liability. How much bank is liable to and to whom? Well, we call it deposit. Bank's liable $100 to whoever put deposit in. Okay, this is balance. This is balance. Let's say another one comes put $50 in here. Okay, then total asset of the bank goes to 150. Okay, now is liable to first person for $100, to the second person $50. The liability is 150. It's always balanced. It has to be equal. It has to be equal. Okay. Let's say the owner of the bank has $70. He put it in there himself, right? Then he raised this one to 120. Okay. On the liability part, what do? We don't say that deposit. We say owners. We say owners money or owners equity for $70. Okay. Then again, this is balance. It's going to be 220. Then assets should be equal to liabilities. Okay, we put here plus owners equity. Okay, plus owners equity. If owners put their money in there, and they usually do, right? Okay. Then we already talked about fractional reserve ratio. If the government comes say, okay, you can't lend all that 220 out. Okay, let's go back here. You can't lend all this out. Okay, you gotta keep at least 10 in your reserve. And this bank goes lend to somebody $90. Okay, then this is going to be 10. He has $10 cash. By law, if the required reserve ratio is 10%, he has to keep $10. But he can lend this one here. Okay, and nothing changed here. Still is the same. Okay, well, we put this one just loan. Okay, $90 loan, $10 reserve or cash, make it $100, is the same as $100 deposit. Okay. Now, if this depositor want to come get his money out, $100 out, then banks only has $10. Then what's going to happen? Remember, you can go to Fed and as a lender of the last resort, and he said, I need $90 because this big shot guy came, got all his money out. Wants 10 billion out. I don't have it. Mine is lent out, and they give me at the time every month. Okay, they give me a little at a time every month for 5 years. I give somebody loan. The banks, Fed comes here, rescue this bank. He give him the money, okay, to give it back to that depositor, and the money that these people pay, it goes to Federal Reserve Bank. Okay, he is the one now to take care of those loans. Okay. Fractional reserve ratio is the banks hold only a fractional deposit as reserve. Reserve ratio, fractional deposit that banks hold as a reserve. And reserve requirement, 10%, 5%, that can be changed by the Fed. That's another tool for Fed to change the money supply in the system. Minimum amount of reserve that banks must hold and set by the Fed. Okay. Now let's go see here how banks can create money. Remember those checking accounts that you write money on it? Those checking checks, buy things with it. It's not cash. It's not currency. It's a piece of paper you write down on it. That's just like money. Let's see how that created money. Let's say bank may hold reserve above the legal minimum. Let's say government here says 10% required reserve ratio, which means bank, you have $100 deposit, you gotta keep $10, but you can lend 90 max. Sometimes the banks might hold $20, okay, excess reserve, okay, lend 80, okay. Some banks are busier than the other one, you know, they do the max, some not, maybe 50 and 50, okay. It just depends. Banks may hold reserve above the legal minimum. Okay. Now, how banks can create money? Okay, banks hold a fraction of deposit in the reserve. Banks create money. Okay, we know about asset and liability. We just talked about increase in money supply does not create wealth. Okay, increase in money supply does not create wealth. It's just the medium of exchange. It's money into circulation. Wealth is different than money. Wealth is how much amount of tangible stuff we created in the economy. How many cars we can make, how many airplanes we can make, how many stuff. But creating money is not wealth. Okay? Differentiate between those two. Let's say bank, first bank, if you recall here, the first national bank, okay, the first national bank, somebody put 10,000, I mean, $100 in there, 100 billion, whatever, unit. And bank's deposit is 100 dollars. This bank, let's say, required reserve ratio is 10%, which means the first bank, by law, he has to keep $10 in cash. Let's say he lent $90. He lent it out, max it out. Okay, that's his portfolio. He gave a check to this guy. Okay, he's a businessman. He got a check for $90. Now let's see transactions all with the check. Okay, these are assumptions. Make you understand this mechanism here. Now this guy here, let's say he has account in another bank, okay, which is second bank. What he does, he come deposit that check in his bank. His bank deposit goes up $90. By law, 10% of this got to be held as reserve, which is $9. And this guy, the currency is not there, but it's a checking account. Somebody else come, he can lend the money to somebody else, max it out. 90% of this deposit, which is $81, he just lend it out. Okay. Let's say this guy get this check from this bank. Okay. He write checks. He buy things by checks, right? Then he go deposit in his bank. Third bank, $81 deposit goes up. By law, he has to keep 10% as a reserve, not excess reserve, which is $8.10. And he goes and lend the rest of amount, which is $72.90. And just keep going like this. They lend this out, the guy goes put it in his bank, or maybe to this bank, or it doesn't matter. You know, the deposit keep going up, and the bank start lending money. Okay. If you keep going like this, $10 deposit created $1,000 money supply in the system. Okay, it's just a checking account. Increase the money supply in the system. How did we come up with 1,000 from 100? Okay, we come with this concept of money multiplier. The money multiplier is equal to 1 divided by required reserve ratio. I just put it on. Okay, how much was the required reserve ratio? 10%, right? I put 10% here. 1 divided by 10%. Money multiplier is equal to 10. If the deposit increase in the bank by $100, you multiply that by money multiplier, I put it MM, which was 10, and the money supply increase, I put increase in M or M1, doesn't matter, okay, in M, money supply. It's going to go up by $1,000. That's how bank can create money. And if Federal Reserve control the behavior of the bank, he can control the money supply. Okay, he can control the money supply. Okay, let's look at it here. The money multiplier is the amount of money that banking system generates with each dollar of reserve is the reciprocal of the required reserve ratio, 1 over all. The higher the reserve ratio, the smaller the money multiplier, right? Let's say government comes and says, okay, instead of 10%, remember make money multiplier 10. Now you all got to hold 20% of your reserve, which means you take the ability of the bank by lending less. Now the banks have $100 deposit, they only can lend 80, not 90. And when they do that, the money supply, the money multiplier will shrink. Instead of 1 over 10, it's going to be 1 over 0.2, which is 5. Then $100 deposit only created 500 instead of 1,000. Then if the government manipulate this R, it can manipulate the money supply in the system. That's called monetary policy in the big picture. Okay. Let's go on here. Now, we want to see what happened in 2008 and 2009. Okay. This is the crisis. We call that Great Recession. We call it Great Recession. When the economy tanked. Why? The banking ability to lend money out, it destroyed, it shrank, it decreases dramatically. Okay, why? Let's go back to the T of the bank. Let's go back to our scenario. Let's say this bank, somebody, let's Chase Bank, has about $800 billion deposit by all different kind of venue. Okay. All different kind of venue. They put $800 billion in that, which is true. That's how much those banks have. Even more, maybe $1 trillion have money in there, right, in their bank. Out of this 800, okay, also the owners, Mr. JP Morgan and all that, they only have $50 billion of theirs in there, okay? And this bank also went borrow money, 150 billion. These are liabilities of the bank and equity, owner's money, right? This is owner's money, 50. That's 150 how much they borrow, okay? They have all this money, they were still short. They will borrow another 150. When the bank borrow money, they do that. They do it from each other, from, you know, Chase Bank on this corner maybe needs some money. Somebody can borrow money, and Cross Street American Bank have excess supply. Nobody borrowing from them. They go borrow from that bank to give it to the other bank. You know, they have different kind of interest rate. They still make little money here, right? Let's say this is the real liability. Out of this, let's say they have almost $1 trillion. Okay? $1 trillion. The government says you gotta have 200 reserves sitting there. You can't lend this one out. Okay, you can't lend it out. Okay, all right. Then the bank goes to spend $100 billion buy bonds. Okay, because they pay good interest rate. Okay, they pay these guys nothing, 1%, 2%. But this security they bought, 5 years, 3 years, they have to wait to get it back, but they pay $4, 4%, 5%. They make money out of these. Also, they go ahead lend this money, $700 billion to all different venues. Mostly, let's say, households that they bought cars, they bought mansions, they bought homes, boats, and all that, right? A lot of them went to the real estate, mortgage, call it, lend to them to go buy houses. Okay? That was beginning of 2008, 2007, 2008, 2005, 6. It started end of the Bush era, and banks held a lot of this money, give it to people to go buy a house. They didn't check uh, truly if those homeowners can afford to pay the mortgage, the monthly payment. Okay? Did they have job? Did they lie about it? And so on. A lot of stuff was going on. Okay? That was kind of loosely operated. Then what happened here? Some of this loan started uh, going bad. Okay, people had those loans. I'll say almost all of it. Let's say $600 billion. People are supposed to make monthly payment, right? $4,000 a month, $3,000 a month, $8,000 a month for those mansions they bought in California and Florida and all that. They stop. They live in the house for 5, 6 months without paying. You can't just throw them out. You can't evict them that quick. You gotta go to the court and so on. Then bank started losing money, losing income. All right. Maybe all 700 of them disappeared. 600 billion of them disappeared. Right. What happened here? The banks were going under. The banks were going under. Money got to come in by these people. New people got to come borrow money. Business people, corporations, they need cash to build up their facility, their factory. All this went uh, under. Okay, started to end of 2007, 2000. Okay. Then 50 billion of them, $1 billion of them is belong to the owner. They're losing 700 billion. Now the rest of them belongs to people. Belongs to these people that lend money to the bank. Belongs to these people that deposit the bank, right? And they panic. They want to get their money out, and the banks collapse. We don't have money. Okay, it was bunch of. Okay, and that's the start from real estate and leak into financial sector and to the mainstream. The companies, the manufacturers, they start laying off. They they don't have access to the money to borrow, expand, and all that. They shrink the whole economy, kind of like a domino effect went down. Uh, by leverage, we means use of borrowed money to supplement existing funds of purchases of investment. Okay, leverage means we go back in here. The owners only have $50 billion of their own out of all these assets. Okay, and out of trillion, 50 billion was theirs. Okay, that's the leverage. They borrow money. I mean, they lend money from borrowed money. Okay, when they went under more than what the whole thing is, then bank goes down. That's why we call it leverage. Use of borrowed money to supplement existing funds purpose of investment. You got leverage ratio of assets to bank capital. Okay, and our example was 50 to 1,000, 52,000. Okay, which is about 20%. Okay, now government can control that. Government can regulate that. They says, okay, you got to have minimum amount of bank capital. If you want to open this bank, at least 20% of the asset must be owner's money, not all of it from the people's money. Okay, that's what the capital requirement means. The bank's asset rise that's kind of give you an example of what we just did. Let's say bank asset went up 5%. This is a positive. That's good. Then because some securities the bank was holding increased by in the price. Let's say the security the bank has was $1,000. Now the price went up to $1,050. The bank capital went up from 50. All that 50 goes to bank's capital, to the owners. Okay, they went 100% more. The leverage was 20%. 5% in increase in the asset brought up 100% increase in the owner's equity, right? And vice versa. The bank can go down 5% for some reason. Let's say the security went down from 1,000 to 950. Then what happened here? The owner's equity is wiped out. Okay. The owners lost 100% of their money. Okay, they insolvent. Okay, that's all the other money. It doesn't belong to them. It belongs to the depositors. Okay, that's what it's talking about. That's what happened. The banks lost their owners' equity first. They were insolvent. They didn't have no money in their asset that belongs to them, and people panic and try to get their money out, and the bank has to close down, shut down. If bank assets are reduced in value of more than 5%, because some people who borrowed from bank default, those are the homeowners, mortgage people, for a leverage of ratio of 20%, the bank's asset would fall below its liabilities. The bank would be insolvent, unable to pay its debt holder and depositors in full. That's why the government has to come in and rescue those banks in 2008 and 2009. Okay. Many banks in 2008, 2009 incurred sizable losses in some of their assets, mostly the mortgage loans, that loan that was to the people who buying houses, and security backed by mortgage loans. And then they were short of capital. They couldn't lend money anymore, right? We call it credit crunch. Right? Contributed to severe downturn in economic activity and dragged us down to severe recession. And we call it Great Recession, worst one after Great Depression in 1939. Okay. Then what happened? U.S. Treasury and Federal Reserve Bank put many $billions of the public funds into banking system. They give him money. They saved them to increase the amount of capital, bank capital. Temporarily made U.S. taxpayers a part of owner of the banks, or where that money comes from. Then where people got to pay it eventually. The goal was to recapitalize the banking system so that the bank lending could return to more normal. And by late 2009, finally, that was when Obama administration took over, right? Finally, they got it all together and put the economy back in track. And it went up and up and up, until 2016, and hand out to this new administration. It went up to now here, and now we facing Corona, which is dragged on us. Okay, economy is tanking again. Okay, we tank here. Okay, tank here, and the Bush, beginning of the Obama, kind of save it through this monetary policy, which increased the amount of bank capital to put the economy in the track. Unemployment was 10% here. Obama handed out to new administration and brought it up to 5%, and it went up even better, 4%, something like that. Now it tanks to, again, 15%, 20%. Now we're going to see what is going to happen. All right. Again, federal tools of monetary control that influence the quantity of the reserve. Okay, it could do open market operation, Fed lending to the banks, or it could influence the required reserve ratio. These are kind of two tools. Okay, by open market committee or open market operation, open federal open market operation done by open FOMC. That's one tool he can use to change the money supply in circulation. The other one is required reserve ratio, okay, the R, okay. Also, Federal Reserve can lend money to the bank or paying interest on the reserve. These are the tools that Fed can use to monitor monetary supply in the system. Again, go on through all this. There are a lot of examples in your textbook. You can just do some of those questions they ask you on this chapter and polish it up. We just here introduce you to the big picture here. How Fed can manipulate the money supply in the system. Then here again, open market operation. Fed can go buy and sell bonds. Okay, U.S. government bonds. Okay, to increase again money supply, Fed can buy the bonds. To reduce the money supply, Fed can sell the bonds. It's easy to conduct and is used more often. This tool is probably usable one for the Fed. Okay, and Fed lending to the bank. Also, Fed can lend money to the bank. Okay, this is the bank here. Okay, and this is the Fed here, sitting here. Fed can control the behavior of this bank. What the bank does, he wants to lend money out, okay, to make more money, right? But Fed can control it. It can say, okay, you got some money in there. The people deposit there is, let's say $100, and the required reserve ratio is $10, and you got $90 to lend out. Okay. When the bank lend out money out, remember he created money. Let's say Fed doesn't want to do that. He doesn't want bank create money. He comes and says, all right, come here, put some of your money with me, Okay, I give you interest rate. I give you interest, 10%, more than what you can do outside. Maybe it's 8%, then it kind of entices him to say, yeah, I give you 10%. That way, it takes the ability of the bank to create money. Okay, you want to cool down the economy. Sometimes it does the other way around. Okay, you give him money, okay, or buying his bond and inject money into the system. To give him the ability to create more money. Okay, that's Fed lending to the bank, increase the money supply. Discount rate is another one. The rate that government does charge them is called discount rate. Discount. I say, okay, you want to come borrow money from me? Okay, that rate is called discount rate. Okay, okay, it's discount rate. If you want to increase the money supply, you lend them the money. There's another one, term auction facility, to the higher bidder. He says, okay, Fed says I got $1 billion here. Okay, I got $1 billion sitting here, whatever it is, right? Who wants to borrow this? Let's say Bank of America here, Bank of Chase Bank here, National here. There's a million banks all over, right? Thousands, right? They need money. They have customers want to borrow money, but they don't have enough. They just go borrow this money. He give it to the one that give him the highest bid. That's the auction. That's the highest bid. Let's say Chase Bank win it. He says, I give you 10% if you give it to me. Okay, then he won that $1 billion. Okay. Then he can turn around, lend it to someone else, and charge him 15%. He has somebody wants that. Okay, then these are different venues that Fed can control money supply. Okay, discount rate is interest rate at the loan that Fed makes to the banks. Higher discount rate reduce the money supply. Smaller discount rate increase the money supply. You can see the mechanism of how it works, right? By the way we just talk about it here. What else? Auction term, okay, is new. It started using for the Great Recession, get back economy on track, and eligible banks bid to borrow those funds, give the highest one, and loans go to the highest eligible bidder, accept the collateral, and pay the highest. All right. Now we talk about reserve required ratio, how that can change the behavior of the bank in increasing or decreasing the money supply. I'm not going to go over that again because we already did it. Okay, paying interest on reserve also is another tool. Yeah, just glance through all these other mechanisms that Fed can use to manipulate the money supply. Okay, that's a paying interest on reserve. Just glance through all those. Fed can do all those, right? But the problem with it is he cannot control the money supply precisely what he wants to do because he can't control behavior of the household and he can control the behavior of the banks, the amount the banks choose to lend or choose to borrow or the households. Okay, it might be 90-80% of the target that he's aiming at, but about 20-10% is out of his control because he can't control the household behavior or behavior of the banks or ability of the banks to lend money and borrow. All right. And we already talked about banks run. Banks run is when all the depositors fear the bank may go bankrupt, run to the bank, withdraw their depositors. Okay. I don't know if y'all saw that movie. It's a Wonderful Life. And there is a clip that shows uh, people run to the Mr. Bailey's bank to get their money out, because the rumor was that Mr. Bailey taking all the depositors' money and going to honeymoon and run away. Okay, panic happened. That's a good movie. If you haven't watched it, I highly recommend it. I see there's a clip, a picture here, in here. Right? We usually watch it in our classes, 6 minutes clip. It actually happened in early 1930s. A wave of the bank runs and bank closings, household and bankers more cautious. Household withdraw their deposit from the banks, and because of some rumors or some legitimate problem with the banks, and people run on the bank. Run on the bank means all depositors run to the bank, get their, and we know already what is going to happen. Right? Banks have to close down, shut down, and run away, and with people's money, whatever left. That's what we created Federal Reserve Bank. Talking about Great Depression, bankers responded of failing reserve, reducing the bank loans, increase the reserve ratios, smaller money multiplier, and decrease the money supply in the system, and causes the Great Depression. Okay. These days, we don't have no bank runs today, okay, because we have FDIC. Okay. If something happens, up to $200,000, most of the bank, $1 million is insured. Let's say somebody had $1 million, they put it in one bank, the bank shut down and closed. That depositor have $250,000 of his deposit back. Is insured. Okay, is insured. That's why most people, they don't put all their money in one bank. You can put your $1 million in 5 different banks. Okay, if those banks close, you all get your money back. It's called FDIC, Federal Insurance Corporation. Federal funds rate. Okay, this is another tool. Okay, let's just disregard that. The very last tool. Okay. Then we're done with adapter here. And we're going to go on chapter 17, talk about money again. So what is the classical explanation of money in circulation, the cause of inflation, and so on? Then let me stop recording here. You got access to this one again.